I think we were on equity swap.
Yes.
Yes. Let's just try this question. Interesting question, interesting concept. And we would just be doing a simple calculation of how we would have perceived this.
Yeah. So the return on the DAX is 5%. What he has to pay is basically 6% plus 30 bips, which is 6.3%. So which nets off to him paying 1.3% on 80 million, which is on 80. And it says that it has what? Semi-annual settlements. 520,000. That's the amount he has to pay to the person he's engaged in the swap.
Everything, all inclusive.
What?
All inclusive. I mean, the net payment that he has to make. So what I want to understand is, it's the question says.
Oh, okay. Wait. 1 sec. Sorry.
The gain or loss on the portfolio, the cash flows on the swap, and the net position of the fund manager in both the scenarios. So let's look at the scenario 1 first. And what I want to understand from you is that since he has tried something, so what is the net position on the fund manager?
Net position means, oh, okay.
Basically, there's a swap, right?
He's increased his exposure to 280 million of long portfolio.
I wanted to solve this and give me the exact number of how much the value would be, because what you're saying is half right. So I want to understand if you really understand what's going on here. He's saying he has a 200 million euro portfolio.
Yeah.
Right. And while he thinks, so he's holding 200 million portfolio, and then the pension expects the index to rise in the next year. So basically, he's expecting that the value would rise the next year, and hence he thinks of increasing the exposure to 40%. So what is 40% of 200 is 80 million, right? 40% of 200 is 80 million. So first of all, the question might not give you this value, might not. Then you should be able to calculate that he's talking about 80 million value.
Okay.
First thing. Second thing is, what the point is that he could have bought these markets index. He could have invested into market index, but then he said, okay, I would not invest into this per se, but I would enter into a swap on the same notional amount of 80 million, where he would be paying a floating interest rate of 30 bips, whatever the floating interest rate plus 30 bips. And since he's thinking that he would, the index would go up, so he would expect to receive the return on the equity index.
Yep.
Understood the situation?
Yeah.
Then they say that the tenor is 1 year with semi-annual payments. The DAX 30 at the time of initiation is to 12,400 points. Now the point is, they say that the 6 months floating reference rate is 6%. So this value is 6%.
Yeah.
Right. So the idea is that he will be paying 6% plus 30 pips to that person. Right.
Yeah.
On how much notional value?
80
million, 80 million euros. Perfect. And he would be receiving the return on the index, whatever it would be, again on 80 million. Right. So I wanted to calculate how much he paid, how much he received, and how much his portfolio value will be at the end of 6 months.
Okay. My question is this: when I'm comparing the two returns, so return of equity index and the 6.3%, am I supposed to semi-analyze the 6.3 as in divide by 2?
100%, no doubt about it.
Okay. So the index has risen 5%. The float that he has to pay is 3.15%, which is 6.3 divided by 2.
Okay.
So net he receives 1.85% on 80 million. So that translates to 1,480,000. His portfolio of 200 million has increased by 5%. So that is 210 million. So his net gain is overall 11,480,000.
Okay. Perfect. So you know what's going on now, right?
Yeah.
Okay. How about scenario 2?
So in this one, there's a negative 5% loss. I mean, decline in the market value of the index. He has to pay 3.15%. So net, he has to pay 8.15% to 80. So he has to pay about 6,520,000. And on his portfolio goes down by 10 million. So overall, he has to pay 16,520,000. I mean, his net loss.
Yeah, net loss. Okay. So my only question to you is, I mean, your answers are absolutely right. So before I explained everything to you, were you still of the same opinion that this is how we should do, or did it change somehow on when I explained on what needs to be done?
No, I understand. I didn't know we had to calculate like net loss. I was just calculating the settlement. I think the only thing I was confused about was the 6.3 divided by 2.
Okay. Okay. So we talked about it. Whatever interest rate that they give you has to be adjusted, and every rate, no matter whether they mention this or not, they will all be on annualized numbers.
Yeah.
The next topic that we have is the equity futures. Very similar. You can imagine that it will be very similar to the forwards. It's just that they are standardized, right? And one of the problems that you would imagine with this is that since your exposure could be of different duration, while the futures that are available are of different duration. So as we discussed, there will be some kind of a spread risk or the basis risk.
Yeah.
And then you will realize that you might not be able to hedge your portfolio completely.
Yeah.
Right. Now, the idea is that why would you again get into the concept of equity futures? Is again, let's say you have a equity exposure, and you immediately realize when you got up in the morning that there's an Iran war.
Yeah.
And you obviously would know that there will be impact on the share market.
Yeah.
Right. So one thing that you could do is you can sell the futures.
Yeah.
That's how you can offset. Right. Selling the futures would effectively reduce your equity position. Are you clear on this one?
Yes.
And why?
Yes.
Right. And obviously, when you buy, it will increase the position. Just in case you think that the market is going to go up, you can obviously do that.
Yeah.
Right. Again, there's one more advantage of doing this. So obviously, in a short term, when you think that the changes are temporary, and I hope you understand that whatever that we are doing in case of hedging in terms of gaining exposure, we believe that whatever that we are thinking, the market will go down, the market will go up, is all temporary.
Yeah.
Why I'm calling it as a temporary? Because if it is a long-term thing,
then you'll just sell.
Obviously, either I'll sell or either I'll buy. I'll gain my exact exposure. But the idea is that whatever contracts that we talk about, futures, forwards, or whatever, they have an expiration date.
They have an expiration date. Yeah.
Right?
Correct.
So when I say they have an expiration date, it clearly means that I'm looking at a short term. I'm looking at some tactical allocation.
Yeah.
But I think that something's going to happen in 3 months. Let's just get into future contracts and get the right exposure. But the idea is that I would not go into these kind of arrangements if I think that this is going to happen for a long term, and then I would go ahead and just invest. I will be a long investor in those scenarios. I would not think about
Mhm.
options there, right? So these things do really prevail when I think that I want to tactically or basically for a short term. Basically, I hope you know that tactical solution and strategic solution are two different words,
Yeah. Uh,
right?
one has to do with like wherein the exposure is like fixed, the weightage, and the other one you have room to maneuver, like just 5 to 10%. Is that how it is?
Yeah. So, but again, technicalities, you are right, you're not wrong. But the idea again is this is especially short term,
Which one?
the tactical one.
Oh, okay.
The tactical is short term and the strategic is long term.
Which one is the one where you can move the weightages?
Tactical.
Tactical. Got it.
Think about this. I have invested in small cap
Yeah.
and I am a small cap investor.
Yeah.
So my strategic solution is that I have been investing in small cap companies or maybe large cap companies, anything,
Yeah.
any theme. But I got to know from somebody that there's an IPO coming up and it's a hot IPO,
Yeah.
right? And I think I can make a good amount of money in that IPO. And obviously, you know that filling an IPO and then the gestation period and then the results will go out when the company goes public. All these things takes approximately 1 month, let's say
Yeah.
2 months. So effectively in 2 months, you can make good money. So what you can do is you can maneuver your 10% of the portfolio to this
Yeah.
arrangement so that you
Yeah.
can get more money. That's like my tactical strategy.
Hmm. Got it. Got it.
Strategic strategy is still this. No change in it.
Oh, okay.
So
Makes
I'm
sense.
saying that when you think that the market is going to go up or go down, I can get into the arrangement of futures, etc.
Hmm.
Basically, I'm doing something tactically.
Hmm.
Had it been some my strategic planning, I wouldn't have go through this arrangement because all of these things have some expiration date,
Yeah.
right? Also, when I do so, either I'm increasing or maybe I am also diversifying.
Hmm.
I can, right? Diversify. We talked about it. If we are going from one market to another market, then we are
Yeah.
actually diversifying my portfolio.
Yeah.
That way, I can also get into exposure to international markets.
Yeah.
Talked about this also,
Yeah.
right? That maybe maybe even today. I mean, I'm sure even these days there are a few platforms which allow me to invest into US stocks,
Yes.
right? But then look at it as standard way, the way we open a demat account over here in India and then we trade. We will not be able to do so in US
Yeah.
unless you're a US citizen. So I'm saying that way, I'm gaining the international exposure just by getting into these contracts,
Yeah.
right? Basically, the swaps. But the one thing that I want to talk about is that when it comes to futures,
Yeah.
since those are standardized products are in the market, right? These index futures
Yeah.
have some multiplier, right? Although you don't have to remember this in a way that they will give you in the question. But if you are trading with anything related to S&P 500 index futures,
Mhm.
then the multiplier is 250.
250. Okay.
$250. Yeah. Just multiply everything with 250. If you are using with FTSE 500, FTSE 100, then the multiplier is maybe this is GBP 10. So basically the multiplier is 10, and for this is 250, right? It is as good as when you say that you are buying Nifty 50 derivative. It
Yeah.
comes in as a lot of 75.
Yeah.
Right? But then I'm saying that don't worry about this. They will give you in the question. You're
Okay.
not expected to learn these things. Maybe remember these things in a way, I would say. Right? All right. Let's try a question. Very similar pattern, same scenario, but then we are dealing with futures in terms rather than forwards.
Okay, I'm a bit confused, but I'll just walk you through what I have so far. Hello?
Yeah, I'm listening to you. Yeah, go ahead, please.
So he wants to hedge 30% of the portfolio, which is 60 million. So the number of contracts is what I've done is 60 divided by 10, which is 10 pounds per point, which is equivalent to 6 million contracts. I just want to check if that's right first.
No. First of all, when I talk about multiply, you will have to multiply and not divide.
Oh.
Every single time, and usually it goes with the future. So wherever you use 7300,
Okay.
multiply that with 10, because this is related to the futures and it's a multiplier that goes with the future, right? So anytime you use 7300 anywhere, just multiply
Okay.
that with 10. So consider that as 73,000 and you're sorted.
70,000. Okay.
73,000. So I'm saying this is 7300.
Oh.
Wherever
So
you use this futures price, you have to use a multiplier.
okay.
Right?
So it's
So I'm
60
saying
million divided by 73,000, is it? 822 contracts.
Okay.
Oh, it's that is okay.
So I'm saying wherever, look at this, it doesn't have a currency, right? You can see
No,
the
it
one way,
doesn't. No.
one good way to remember is it doesn't have a currency, right? And this has a currency.
Okay,
So
okay.
they just go hand in hand. So basically these are the numbers and this is the value. So you can say that whatever you talk about, let's say 7300 futures price, and then the actual price would be multiply 10 GBP. Basically 73,000 is now can be used as it is in comparison to this value or some other dollar value or GBP value. Make sense?
Makes sense. So then when the price, so FTC increases by 5%, and the future price is now 7,665.
Okay.
Effectively, what's happened is your 200 million equity portfolio has gone to 210 million. But on the 822 contracts that you sold, you're making a loss of 7,665 minus 7,300, which is 365. 365 into the 822 contracts, which is about 300K. So you're basically your 9,700,000.
The one point again you're missing is you're using 7300 and you're comparing with 7665.
Okay. Yeah. So it should be 3,650 into 822.
824.
824.
204.
822 I had.
Yeah, 822. Okay.
Just a second. 650 into 822. Yeah, so that's 3 million. So 7 million, on a little less than that. 6,700,000.
Almost there, but are we missing something? Did you do 365 multiply 10 multiply 822?
Yeah.
How much the value turned out to be?
So it's 365 into 10 into,
You know how 365, right?
yeah. So that I'm getting as 3,300,000.
3,300,000. So 365, 10, and then 822. Right? So this is what you're getting right now.
Yeah.
Okay. So how about profit loss transaction? What's going on?
So this is how much you've lost because you were short a contract.
Yeah.
And you've gained 10 million from the 200 million equity portfolio because the FTC 100s increased by 5%.
How much that value would be?
10 million minus 3 million, 3,300,000.
Understood. I want to talk about a few things which sometimes our brain just automatically does, but then that holds a very important parameter. When we actually did this one, yeah, we said he wanted to hedge 30% of 200. So basically, he is talking about 200 multiply 30%, right? Which is effectively 60 million, right?
Yeah.
Okay. And then he said that the futures price is 7,300, and then we use the multiplier 10. If you do 60, 1, 2, 3, 4, 5, 6, 60 million, and then you have 7,300, 73,000, and if you divide the two numbers, could you see here, this is 821.9, which we conveniently say that it is going to be 822. But this is a very important point here. Why do you think it's a very important point? Is because it clearly shows that you will not be able to fully hedge your portfolio. Am I right?
Yeah.
You will not be able to fully hedge your portfolio. So although our brain just quickly says, okay, let's just round it off to 822, which is the right answer. I don't deny that.
Yeah.
But it is important to understand that you will always see some kind of a basis risk in this scenario, and you will not be able to fully hedge. And we will also see that.
Yeah.
We'll see that. So coming back to the original thing that you said, that I'm gonna short 822 contracts, right? So we are on the same page. Now you said that since we are short and the value actually increases, right? I made a loss. How much loss? We know that it was 7,665.
3,650.
Yeah, we will multiply later. And then the original, we bought it 7,300, right? Multiply 10, multiply 820. Is that okay?
Yeah.
And you said that you got 3. Is it right to say we got this number?
Yeah.
3,000, 300, right?
Yeah.
Okay. Now, if you look at my portfolio value on hedging, obviously what you did was right in terms of the overall value, that it increased by 5%.
Yeah.
But we actually hedge only 30%. So read the question carefully. If the question asks you to calculate the overall portfolio value, then what you did is right. Right? Because ultimately my overall portfolio value would increase by 5%. But let's just try to understand what's going on with hedging. So can I say that I have exposed my 60 million, 30% of 200?
Yeah.
And that increases by 5%.
Right.
right? So if I'm going to do 60 multiply 1.05, that will give my portfolio value, right?
Yeah.
But if I just do 5%, so this will be 300 million. Is that correct?
Yeah.
Basically,
3
3
million.
million. 3 million, right? But could you see that the loss that I made is
Mm. Oh,
3
yeah. Because
versus
of,
3 million?
yeah,
So there is a difference of 300 that I
yeah,
made a loss.
yeah.
I made a loss of 300
Mm.
GBP or whatever the currency
Pounds,
is.
yeah.
Right? So the point is that I made a loss of 300.
Mm.
Why didn't I make a loss? Although I hedged everything, I wanted to hedge my 30% of my portfolio end to end,
Yeah,
but yet I end up losing 300 is because the hedging is not perfect.
yeah.
It was 821.9. And in an ideal world, if I were to get 821.9, I could have
Mm.
fully hedged my portfolio.
Very clear.
Right? So sometimes we just ignore these small things, but then you could get a question on how much is the hedging risk is. What's the
Yeah.
dollar amount of the hedging risk? So it's actually 300. Make sense?
Mm. Makes
Okay.
sense.
Let's just try the second one. How about that if it falls by 5% and it goes down to 6935? What happened in this case?
Yeah. So you've loss of 3 million on the 60 million portfolio. 7300 going to 6935.
And this time, since it decreased, we made a profit, right?
Yeah. So this is basically again it's 365. So you've made you've made 3,300,000 on the
So you
futures.
can, so you can imagine that the signs have reversed,
Yeah, signs have reversed. Yeah.
right? So this again, the difference is the same.
Yeah.
It again 5%. So it's just that this time we are gonna make money of 300
Yeah.
that we were losing before.
Yeah.
Right? But then I want to make you understand that although we say that we want to hedge, we are not immune fully.
Hmm.
Okay?
Yeah.
Are we good to proceed or do we have some questions?
No, good to proceed.
I like these topics a lot because
Hmm.
there's not much to explain. Explain as
Yeah.
in not as a tutor or as a faculty, but more as a student as well. That I don't have to remember any formulas per se.
Mhm.
Right? I just think what needs to be done and I solve it.
So true.
There's another thing that I want to talk about in the same lines is that do you remember that in fixed income futures we talked about that I can achieve a target duration. Remember
Yes.
BPV of target minus BPV of portfolio upon BPV of CTD
Yes.
multiply the conversion factor.
Yep.
Right? Now, if I can do something like this in fixed income, a duration is somehow as good as beta in the equity,
Yes. Yes. Correct. Correct.
right? Very crude way of saying this, but then a beta is as good as because that also explains my risk. Duration also explains my risk,
Yes.
right?
Market risk.
So yeah, so if I have this formula for fixed income, don't you think that we should have a similar formula somehow in equities to
Yeah.
achieve a target duration? So I would say that very much similar to what we studied, my target duration, target beta that could be achieved is beta of target minus your beta of portfolio upon beta of futures multiplied, right? You had a conversion factor, which was basically the value
Oh,
market value of the portfolio divided by the future contract price. And this inherently, you know that this is going to be your futures value multiply any kind of multiplier. It goes hand in hand. We talked about it.
The conversion factor of in the bond fixed income case was, what was the formula again?
For conversion factor, they used to give every single time.
Yeah, it depends basically on your coupon and the prevailing interest rate, right?
Correct. Right. And just to be sure, I just want to re-verify. It was the multiplication of simple conversion factor, right?
Yeah.
Yeah.
Yep.
So basically, even there, it was market value of the portfolio that we discussed.
Yeah.
Right. And then the conversion factor was used indirectly over there.
Yeah.
On the same lines, we have for equity, where you can always achieve your target duration of the beta plus of the portfolio divided by the futures, multiply the market value of the portfolio adjusted for future price. Is that okay?
Yeah.
Okay. Let's just try a simple question. So when I wrote my CFA level 3, it was paper based.
Yeah, I actually prefer that.
So the good part about that is कि एक पेपर पे आपको लिखा हुआ है क्वेश्चन, तो
Yeah.
आप सर्कल करके डाल सकते हो कि ये क्या चीज है. So while reading, and if I understood what is this, I would quickly tag it to some number.
Yeah.
And then I would know कि ये मुझे पता है और ये मुझे पता नहीं है.
Yeah.
But now on a digital thing, it's a little difficult.
It is. It is. It's much harder.
Sometimes I feel blessed that okay, I cleared at the right time.
How long ago did you clear it?
How long has been? It was 2018.
Oh, wow. Just a sec.
And this time you have to write all the essay type exams over there, right? You have to type, isn't it?
No, yeah. Bloody pain.
Typing speed is not that great, so you lose on that one.
Yeah. Thankfully, I have good typing speed now because I sit in front of a laptop for 8-9 hours a day.
Does it look difficult, easy?
Yeah, it's easy.
Okay.
I'm doing the first part. So I got for the first part 32 contracts.
32 contracts, okay. And was it the exact number?
No, 32.17.
So you know how to round it off, right? So 32 contracts, right?
Yeah.
Okay, go ahead.
Compute. So he has to sell 32 contracts to reduce his beta to 0.8. Compute the effectiveness of the strategy at the end of the 6-month period. At the end of the 6-month, estimated decreased by 1.5%. Effectiveness 1.5%. Okay. So first things first, his portfolio without the hedge goes to 59,100,000, and then the futures contract. What the hell? 32 contracts he has. Decreases by. No, not able to solve this second part.
Before even solving this question,
Hmm.
let's say there are no contracts whatsoever. I haven't
Yeah.
even got into this whole deal.
Yeah, are you saying basically a change in the market price into beta is the change in your portfolio?
This will happen for sure. So I'm saying if he has a 60 million portfolio,
Yeah.
it has a beta of 1.2.
Yeah.
Right? So the value is 60 million and the beta is 1.2, right? The manager believes the market will decline on next 6 months, which should reduce the beta of the portfolio to 8. So this is the beta of the portfolio. This is the beta of the target is 0.8. Using this futures, they currently have a contract price of 2984. And multiplier of 250, we always say that they go hand in hand. Okay, so I don't have to write this separately. At the end of 6 months period, S&P 500 has decreased by 1.5%. So the value S&P 500 return on this will be minus 1.5. Right? S&P 500 is a beta of. We'll solve the question, but the point is, if there is no arrangement, what would be his portfolio value at the end of 6 months? Let's just talk about that.
Yeah. It'd be 1.2 into negative 1.5 into 60, negative 1.5%.
So 60 million multiply 1 minus 0.015.
Yeah. Yeah. Yeah.
Right, or something else. Is that correct?
Yeah, this is correct.
This is half correct.
Into the
beta. Sorry?
Into beta?
Exactly. Because if the market has decreased by 1.5%, you have an aggressive portfolio that has a beta of 1.2. So your portfolio will go down even further. I mean, is there difficulty in understanding this part?
No.
Okay. So I hope you know this, right? That whenever you invest into mutual funds or any kind of investment that you do, and if your beta is more than the market, so obviously if the market increased by 10% and you have a beta of 1.5, then the market, your portfolio will increase by another 50%.
Yeah.
Right? We understand that part. So I'm saying if it reduces by 1.5%, then obviously it aggressively reduces your portfolio value, and equivalent of this multiply your 1 point. Is that okay now?
Yeah.
Right? So 60 million and this is 0.015 and then multiply 1.2. This is 1 minus this, and ultimately this turned out to be 589 58920 right? If there are no future contracts, then effectively my portfolio value will be this much. Now the only exercise that we need to do is how many contracts can we buy, basically short, not really buy. Right? How many contracts can we short and how much that value can hedge my loss. Right? Because if there are no contracts whatsoever, my portfolio value will be this much. So maybe just by doing all of those arrangements, I might be able to reduce my loss somehow. Is that correct?
Yes.
Right? Yes. So we agreed that the person will have to sell 32 contracts. You know how that value came.
Yeah.
Okay. So far so good. Now let's just try to calculate how much that translates to in terms of dollars, right? So it says they have a contract price of 2984 that we already utilized. At the end of 6 months, S&P 500 has decreased by 1.5%. Okay. Now, when the S&P index has decreased by 1.5%, right? How much that value would be? How much that value would be? So you
Of,
already have, huh?
of the portfolio we have.
Okay. No, but then I'm saying the futures.
Yeah, that
Future,
will the price of the future will reduce by 1.5%.
exactly.
Yeah.
Exactly. When the market has reduced by this, that the overall value would reduce by 1.5%. So can I say that this 2984, so I would say the initial value
Hmm.
is 2984.
Mm-hmm.
And can I say that the final value is 2984 multiply 1 minus 0.015,
Yeah.
right? 2984, and this is 1 minus 0.015.
Yeah.
So this will be equal to 2939.24,
Hmm.
right? So let's just assume 2939, obviously. So can I say that I was short on this one? I sold the contracts, right?
Yes. Yes.
And the value reduces, so I made a
Well,
profit.
yeah.
So my profit would actually be, so can I say this is going to be 2984 minus 2939
39
multiply
250 into 32.
multiply 20. Perfect. How much this value would be? Can you quickly solve?
Yeah. 360,000.
360,000. So can I say that effectively my loss, basically my portfolio value was this much before, right?
Hmm.
And then it will increase by this much.
Mm-hmm.
Is it right to say?
It will. Yeah, it'll increase. Yeah. Yeah.
We made a profit, right?
Yeah.
With a short position. So without any kind of arrangement, my portfolio value would have been this much. But just because I entered into a contract and I sold 32 contracts and the value actually reduces, on which I made money. So my overall portfolio value will increase by $360,000 added to this.
Yeah.
Right. So can I say that although the portfolio value reduced by 1.5% and then I was aggressive enough to 1.2 as a beta, when the overall effective return,
1.2% basically. You're trying to achieve that, but it's not perfect hedge.
yeah, exactly, final minus initial by initial into 100, right? So my final value is this much, this added this, my initial value is 60 million,
Yeah.
minus 1 into 100, that'll give you some back, right?
Yeah.
And also one important point that they might tell you is what would the beta of the portfolio?
Yeah. It's 0.8, right?
Have you calculated this already?
What?
Have you calculated this already?
No, I mean, you were trying to get to 0.8 and then the return is also 1.2. So it's
Correct,
like,
correct. So you would see that the change in the portfolio
yeah.
by your change in the index overall that we saw. So this was around minus 1.2%, and this was
Right.
around minus 1.5%. So this is effectively 0.8. So you can see that you were able to achieve the target duration of 0.8.
Yeah.
Good to go.
Yeah, good to go.
There is one more topic.
Yeah.
I feel it just a subset of what we just studied,
Yeah.
and sometimes sometimes it sounds intimidating. They
Yeah.
say cash equitization.
Okay.
Now think about this without even teaching you. anything, can I say that you, from your equity,
Yeah.
you are doing some kind of a arrangement so that it is as good as that you are converting this into cash.
Say that again. Sorry.
I'm saying, I'm saying you are doing some kind of a arrangement
Yeah.
so that you earn what you could earn on a cash,
Hmm. Hmm.
right? And
Hmm.
why would somebody do that?
It's almost like you believe that it's like a swap where you're trying to get like the fixed return, and you believe it's going to go down the portfolio.
Yeah, exactly, right. So you're trying, what you're trying to do overall is that you are trying to get some
Yeah.
return which is as good as investing into cash or basically money markets.
Yeah.
Yeah. Right. So can I say, and what would be the beta of cash?
Beta of cash zero.
Zero. Absolutely. Right. So we will solve a question where we'll see that this is no new thing that we are solving. It's
Uh,
just that we are using the target beta of zero.
Very clear.
Look at this one.
Yeah. So his target is 1. His current is on the 8
Mm-hmm.
million is
Mm-hmm.
0. Futures is 1, right? So his cash portfolio of 8 million divided by 2780 into 250. That is, it's 80 divided by 6.95. So he'd buy 11.51 contracts or 12 contracts.
Right. So there is
Yes.
nothing that we need to study specifically in this. You know what needs to be done.
Got
Right.
it.
Okay. Now let's just talk about one more topic, which they call it as derivative on volatility. Right. One thing that I want to talk about is that there are two things. One is implied volatility, and the second one is realized volatility. So the point is, or maybe you can say implied volatility, or maybe you can say expected volatility.
Yeah.
And then you would also know that the related index is VIX, right? We call about VIX futures or maybe VIX index, right? We call that as a fear index.
Hmm.
Even you would see in market they say that India's VIX has increased to this much.
Yes.
India's VIX has decreased to. So what that VIX is the volatility or the fear index. Now,
Yeah.
what does that show? It just shows that how the market would look like, how the volatility looks like ex ante. Ex ante basically means in future.
Hmm.
In future. So basically, whatever standard deviation that we have talked about so far, whatever we have talked about so far is all about what has been realized already.
Hmm.
How do you calculate your standard deviation? Because standard deviation is a parameter of risk, right?
Yeah.
So if this represents risk, how do you calculate this sigma? I hope the simple standard deviation that you know is your x minus x bar,
Yeah.
right? Square upon n, something that we studied, something like this, right?
Yeah.
What
Yeah.
is this is x bar? What is this x? This is return. And what is this x bar is the average return,
Absolutely.
right? But these return and these average return have already been realized.
Yeah.
So whatever we are doing and whatever we have been doing so far is all about the historical standard deviation,
Hmm.
right? So we at we are here at t equal to 0 and we are here at t equal to t. So what if we are here, we always talk about this. Does it make sense?
Yeah.
But now the VIX, what it talks about is this. Right? And when you see that in the market, when the risk is too high, the VIX peaks. Something like this. Right? So you can say that this is time and this is volatility.
Yeah.
So VIX will actually tell me how people, it is more about how people perceive the markets in future. Right? If the VIX or the value of the implied volatility is too high, what does it signify? It just signifies that it is going to be a bearish market. If the VIX values are too high, it just shows that it is going to be again, we talked about everything future, right? So we say that immediately, if it is too high, and then you might know that when there was a airplane crash, when there was a demonetization, when there was a war, the VIX index is high. It means people are now cautious.
Yeah.
People are now scared, and they might want to exit from the market.
Yes.
And if they exit from the market, it clearly means that the sentiment is bearish.
Yeah.
And then if when the VIX is too low, it just signifies the bullish market.
Yeah.
When the VIX is too low, they say that okay, the market is too bullish. It means that the sentiment is too aggressive now. Okay. One more thing, if you realize that I'm saying that when the VIX values are high, I'm calling them as a bearish.
Yeah.
It means when the market is bearish, the equity return would be negative
Yes.
in a way, right? And when the VIX is too low, I'm calling it as a bullish. That it will happen, the market will become bullish, but then the equity return will be negative, the positive.
Yes.
So in a way, is it right to assume that they have a negative correlation?
Yes.
Right? They have a negative correlation.
Yeah. Yeah.
Is it okay to assume?
Yeah.
And if they have a negative correlation, one thing to my advantage would be that if I think that volatility is going to be too high, right? And if I don't have anything else to trade on,
Yeah.
and I think that the equity market is going to go down, and
Yeah.
I want something, I can actually invest in VIX futures, right? So basically, VIX futures has a negative correlation, obviously. So if I think that the market can go down and the volatility will increase too much, right? And if the volatility will increase, VIX future value will increase, obviously.
Yes.
Is that okay so far?
Yeah.
All good? Okay. Let me show you a few things and then we'll proceed. Right? Look at this one. The VIX computes the weighted average of the implied volatility inferred from S&P 500 trade options, call input, whatever, just leave that, with the average expression of 30 days, right? Although they gave you a calculation, a simple, but this will not be used in the exam and nobody's going to ask you to calculate a 30-day return. But then what they're trying to tell you that if the VIX was at 20, we could interpret it as telling us that the market expects that the S&P will stay within plus minus 20% range over an year with 68% confidence level. This is CFA level 1. Remember that? We look at usually 2/3, right? Just forget this for now. This implies that is going to be 20 divided by root 12, 5.77, over next 30 days. And I hope you know why did we do root 12.
Yeah, because of
Volatility, we always do a square root, and since it is they're doing for monthly because it was for year, so they did for 12, right? But again, this calculation is not relevant because you will not be tested on this one in the exam.
Yeah.
Look at this. So when it was around May 2008, you can see.
Yes.
Somewhere around when you have a bubble, right? The what was in 2008?
Recession.
The
Recession.
recession, right? Yeah, the recession. So there, your VIX was too high. So this actually represents the bearish market. And if you look at these lowest levels somewhere, these could represent a bullish market. Is that okay?
Yeah.
Now, another thing that I wanted to show is this one. Look at this. It just shows the correlation between the VIX and S&P. Basically, VIX and equity. And look at this. It's negative. Right? It is negative. Right? So then this also tells me that I can actually invest into VIX futures, right? But then it also tells you one important thing. Can you see that? The cost of carry model cannot be used to determine the fair value of the future because obviously there is nothing called as spot VIX. Everything is all about future, right? This is implied volatility. If something is spot, it is realized, and either it will tell you about the past or at present.
Yeah.
But since VIX is all about future implied volatility, so there is no way that you can calculate the spot VIX, and you can invest in VIX futures.
Yeah.
Okay. All right. They also talk about one important thing here that I want to discuss now. Something called as contango market. You must have studied contango and backwardation in CFA level 1 somewhere, right? In derivatives.
Commodities, yeah.
But the concept is still the same, that in contango the value is increasing and in backwardation the value is decreasing. But then I want to extend this discussion a little bit to the point that what this value is increasing and what does it mean? Right? Can you see? Let's look at this one. We can see that the value is increasing, but what could have happened here that the value is increasing? And what does it mean if the value is increasing? How does it help me to understand? Right?
Bearish view.
Sorry? The bearish view. Okay. So what could have happened here, and why do you think the curve is something like this? So what the point that we're trying to understand is what could have happened just before this period?
There would have been a steep decrease in prices, equity prices.
Steep decrease in equity prices. Okay. And if there have been a steep decrease in the equity prices, then how does it work?
The VIX future prices would increase.
The VIX future prices would increase. Okay.
At a increasing rate, and then it'll plateau because the belief is that in over a long term it won't reduce that much.
All right. I'm also thinking. So let's take two scenarios. One is that there is a war. So everything is fine today. And we got to know at the end of the day that there is going to be a war and people are now scared. So when you look at tomorrow morning, right, do you think that you will see a contango, or do you see what do you say, do you see a backwardation in the VIX futures? So tonight there was a war declared.
I would say contango.
You will see contango. And why is that so?
Just the uncertainty is there. You don't know when the war will end.
Okay. But think about this, Gaurav, and then correct me if I'm wrong. I could be wrong somewhere. So when the war is declared tonight, volatility tomorrow morning will be too high or too low?
Too high.
So when the volatility will be too high, technically this number should be at the highest point, right?
Yeah.
And then when the market when the market accepts that with time it might go down, maybe.
Right.
Right. So in case of a war, I don't think that contango would be the case. Rather, I would say backwardation would be the case.
Yeah.
Does it make sense?
Yes.
Let's look at this, and I would also, I mean, it's been a while since I have looked at this. Let's just see. The chart future shows the y-axis, the future. Look at the data as of 18 July to 2011. The VIX futures in contango negative. Okay, I want to talk about backwardation for now. Less than 1 month later, the term structure of VIX futures has completely changed and is now in backwardation. We can interpret this shape as a market expecting 30-day volatility to decrease over the time.
Yeah.
So we say we can interpret that it will decrease over the time. The cause of the sudden change from contango to backwardation was a sudden increase in the VIX index caused by the S&P downgrade.
Yeah.
Right. So if the S&P downgraded from AAA to AA plus, it means it's a negative news. So when there is an immediate negative news, so you would see that the VIX prices were at the highest point immediately. And then with time, it will go down because the market would stabilize. Is the concept clear?
Clear.
Right. So can I say, in short, that if my risk increases immediately, then I would see backwardation. We just saw, right? When the S&P downgraded, we saw
backwardation. Yeah.
Right? And then obviously the opposite is contango. Is that clear?
Yeah.
So one good takeaway is always look at a real life scenario, what could have happened and how it could have reacted first. And second, always remember only one thing. One thing as in case of a call and put, just remember call because it's easy to remember, and the put will be opposite of call. Don't try to remember put. Similarly, if you understand this part, don't try to remember what the contango situation will be. Look at the question and see if it satisfies the concept of backwardation. If it doesn't, it is going to be contango. Right? Okay.
Yeah.
One more thing is, similar to what you studied as a contango and backwardation in CFA level 1, you also might have studied about roll yield.
Yes.
Right? Okay. Now, a lot of people and a lot of faculties teach differently in terms of roll yield.
Yeah.
My way of looking at roll yield is very simple. They're not asking you to define what a roll yield is. They want you to know if it is positive or negative.
Yeah.
Right? My way of looking at it is very simple.
Yeah.
This is contango.
Yeah.
Right? This is price. Is that correct?
Yeah.
You can imagine that this will be, let's say this is 20, this is 30, and this is 80. Right? If I am long contango, I am buying at 20 today. I am buying at 80 after a few days. So initially I was buying at a cheaper value, and later I have to buy at a higher value. Right? So basically I will have to roll over my contract in a way.
Yeah.
Think about this. You're buying an insurance. You're buying an insurance. So today you paid 2,500 for that insurance. And next year, because you have to roll over the insurance every year over year.
Yeah.
When you roll over your insurance, you are going long on insurance basically. Next year you paid 3,200, right? So don't you think that your rolling over cost is negative?
Yes.
Right? So my basic rule of understanding and learning this is, if I'm long on a contango market, why I'm using the word long, because I have to buy, right? If I have to buy on a contango market, my roll yield will be negative. This is a case of contango where you had these as, let's call them as price for simplicity, right? And this is time. It's just two ways so that you can remember. So you can say that this is 20 and this is 30. So at this time it is 80. Let's say you are buying at this amount at this time and you're buying at this. Let's say this is 2001 and this is 2000. So it just clearly shows, and you are bound to buy. Assume that you are bound to buy. So here, while you are buying at 30, right, and in 2001, and buying the same quantity in 2002, you end up paying 80. So basically, you made a loss in rolling over. Hence, your roll yield is negative.
Yeah.
And had you been short on this position, your roll yield will obviously be positive. Is that okay?
Yeah.
Very quickly, let's just look at, although it is intuitive, but let's just look at a case of backwardation where same things happen. This is 80 and this is 20. You are again long backwardation, right? You are buying at 80 before, and while rolling over, you will end up paying only 20 now. So it's a profit for you. For same 1 kg apples, while you were paying 200 rupees per kg, for now 1 kg apple, you're only paying 50 rupees per kg. So rolling over the same contract actually give you more. So basically it's a profit, right? And again, if you're short, it's a loss. Clear?
Yeah.
So I don't need to get into what a roll yield is. I don't need to get on to know how exactly does it work. All I need to know is, if I'm long or short, what's my structure, if it is a contango or a backwardation, and I would know if it is positive or negative, right? So I saw a lot of students that get confused with roll yield, even in CFA level 1, level 2, right? But when I tell them this, they say that Ankur, we don't know what the value is, but I know that it is negative, right? Okay.
Yeah.
Let's just look at this. These 4 points, and let me know if you're okay with this.
Yeah. Clear.
Yeah. Okay, perfect. Let's look at another concept. Which is, one thing that you need to know is, could be asked somewhere here or there. So when it comes to VIX options, right? I hope you know that there are two kind of options. One is American option, and one is European option. You know the difference between these two, right?
Basically, the settlement date when it can be exercised or settled.
Which one can be settled when?
American, in the spirit of free capitalism, can be anytime, and then European only on settlement date.
Since VIX option, we don't know what's going on. We don't know what it would be. And only we get to know once the contract expires.
Yeah.
So VIX options are only European options. Okay. So basically we say that we decide on a value today, right? And then what that value is going to be at the end, nobody knows, because that's implied volatility.
Yeah.
Right? So let's just wait till the contract expires, and at that time we'll do the netting. No offsetting, no going back and forth, no American thing going on. So straight away, it's a European option. Right? I don't think you're going to get any question on this part per se, but then theoretically, at least you should know that VIX options are European options. Okay. All right. Similar to what we have studied for a lot of different things, you can also have, and sometimes I wonder कि कितने कितने products market में बना दिए just to make money.
Yeah.
Right? You can also have variance swap.
Okay.
मतलब इसके ऊपर भी खेल लो, कुछ मत छोड़ो. ठीक है, जहां से मिले मतलब सट्टा है ये. Obviously, right, in a swap you are just speculating what could happen in the future. Two parties come together to think that this will go up or go down, and then they enter into a contract. It's just a swap. Right? So they say that even for variance, right, the volatility, you can enter into a swap. But be cognizant of the name, although you are playing with risk, as in volatility, right? But look at the word here, variance, which means whatever you would do in terms of sigma square. Right? So even in the exam, and then a lot of people make this mistake sometimes, that they give you the question, they give you the value in terms of sigma. Make sure that before solving or before getting into the answer, you first square it and then subtract it. And I hope you know that sigma minus x square versus sigma square minus x square will not be equal.
Yeah.
So when I say that the netting is going to happen, and in a jiffy you think that okay, I can quickly solve and get away with this, you immediately subtract and then you do a square. It is not be equal to doing this.
Yeah.
Right. Okay. So the point is how the swap works. That there is obviously one party one, and then there will be a swap dealer, obviously. Right. So they initially decide that what would be the implied volatility, because they want to trade on something. When we say that the implied volatility for 30 days is going to be this much, so they speculate something, so they fix on that one, that okay, I would be, let's just assume that the VIX is going to be this much, the variance is going to be this much, that is going to be an implied volatility, which is actually fixed at initiation.
Yeah.
But at the termination, we don't know, which is unknown, and would be known only then. Right? And obviously, you know that I can say that my settlement amount can be given by, again, we look at the notional. So here we will use the variance notional.
Okay.
Right? Multiplied by your realized variance minus variance strike. Basically, what we already decide at initially versus what is going to be in the future. Are we okay with this?
Yeah. Yeah.
Right? Now, the person, think about this. person who will get into this kind of arrangement would be paying realized or paying variance strike. Basically, let me use the word realized versus strike for an easy understanding. So if I'm long, think about this. If I'm long a person, even if I'm getting into a variance swap, right? I already know this value, right?
Yes.
So obviously, I will be playing around with realized variance that is
Yeah.
going to be at that time.
Yeah.
I'm using the word realized variance, but it is unknown as of now,
Yeah.
right? And this variance strike is effectively the implied volatility,
Yeah.
which is fixed at initiation.
Mm-hmm.
So obviously, I will be trading on this one, right? Because I would think that the realized variance or the volatility will be too high in the future at that time. Think about this. People who speculated in January that 2025 is going to bring ABC disasters, right, would trade on such things. Where they think that, okay, as of today the volatility is this much and seems like seems like that it is going to be 15%, 20%. But when I look at Baba Vango, which predicts a tsunami and a crash, etc., I believe that the realized volatility at that time will be much more higher than I think right now. Right? So the person who is long will trade on this, and hence they would say that, okay, if my realized, let me call this as A and this as B. So can I say if A is more than B,
Yeah.
right? The person who is the buyer of the swap
Yeah.
will make money,
Yeah.
right? And if A is less than B, obviously it's a loss, no doubt about it.
Yep.
Is that okay?
Yeah.
One thing that I also want to talk about is in your books, although again, as I said, it will not be tested, but they give you a formula, and then when you want to look at the books, you might think that, okay, this was not covered. So I just want to talk about that they also give you a formula which is called as daily variance, and they use the word summation of r square upon n minus 1, right? Let me just contrast this with what we already know.
Okay.
Right? Do we know that my variance formula was x minus x bar square upon n minus 1? You know, I hope you know why n versus n minus 1.
Yeah.
Right? This is the population versus sample.
Yeah.
So the difference between these two is you would see that this is effectively r minus r bar square versus this is r square. That's the only difference, right?
Got it. Got it.
But why there's a difference is because in a variance that we studied throughout our lives so far, we would want to assume the volatility around the mean.
Yeah. Yeah.
Right? So we used to calculate x bar, which is the mean, and we say that, okay, let's just calculate the volatility around the mean, which means how far are my values from the mean.
Yeah.
And assuming, and that's the reason we do a square, because it doesn't matter whether it is left hand side or right hand side. All I want to know how far are they from the mean, and that's how we always used to calculate the mean distribution.
Yes.
Because all the calculations were around from the mean.
Yeah.
But when it comes to implied volatility, there is no mean. We don't know the mean. Right? We got the mean from the historical data. When we had so many 10 returns, when I had 10 returns, from those 10 returns, I could calculate my X bar and I said, okay, this is the mean. And
Yeah.
from that mean, I'm trying to calculate my dispersion from the mean.
Yeah.
But in an implied volatility, I don't know what my mean is.
Yeah.
Hence, the daily variance formula is as good as what you had studied before, with the difference of that there is no concept of mean in this.
Yeah.
Is that okay?
Yep.
Okay. Uh, all right. There's one more formula, and that is testable in the exam. I'm thinking, and I would take, I think 5-10 minutes, but I think let's just start. You have a meeting right now, right? Okay. Okay.
Yeah.
I'm
Yeah. I
sorry.
have to go at
Oh,
10
okay. Okay.
a.m.
Okay.
I just had a
Yeah. No
shower.
problem. So, yeah. So I'll just start at 3:30 tomorrow, and then
Perfect.
we'll take it.
Thank you so much. Thank you.
All right. Thanks, Gaurav.